Welcome to What School Should Have Taught You, where I share all the lessons you need to know about how to build wealth. I'm Iannuzzelli, and today we're going to be talking about why interest rates rise and fall and how to spot the opportunities. Now, we've really got to go back to what interest rates are and the mechanism that they're used for. Interest rates are a cost of borrowing money, and they're used to control the inflation inside a country. And there's a number of factors that needs to be considered when trying to control the inflation of a country.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
There's a lot of factors that need to be considered when adjusting inflation with the use of the mechanism of interest rates. Now, inflation's very simple. All economies, they want the economy to inflate. They want the economy to grow. And to grow, it may be requiring stimulation, and stimulation meaning lower interest rates, therefore a lower cost of funding. A lower cost of funding means more liquidity. More liquidity means more money being lent into the market, more money being used to purchase goods and services. And thus the economy stimulates. When an economy stimulates too much, it starts to overheat. And that's where reserve banks need to make sure that if there's a lot more money chasing less goods or services, we start to have costs inflating. Now, inflation's a very, very hot topic at the moment. It's what the Reserve Bank of Australia has been trying to do throughout the duration of 2022 and 2023. In fact, it's what most countries' reserve banks have been trying to do throughout the year of 2022 and 2023. And let's really understand how it happened. During COVID of 2020 and 21, the whole world thought the COVID pandemic would absolutely stop all countries in their track. It thought that economies would fall, in fact collapse, businesses would collapse, unemployment rates would be at all-time highs, people wouldn't be able to afford all their goods and services, mortgages wouldn't get paid. In essence, financial Armageddon. So what all reserve banks did during that time was stimulate their economy through the increase of the money supply. They got the money out in the economy through fractional lending, through the banks that is, which is giving the banks the ability to obtain that money from the Reserve Bank at a very discounted rate, on the basis and the proviso that they lend the money out to us, being the consumer, ideally on a low interest rate as well. Now, with all that money floating around the economy, with all that money floating around the world and the systems and the money markets, what it did do was create stimulation for goods and services. It created a lot of money chasing a lot of goods at that particular time. Economics is quite simple. When supply equals demand, that means the supply of goods and services equals the demand that's attached to them. We have what they call market equilibrium. Market equilibrium is our truest form of economics. Generally, the market determines its market equilibrium. But when you have governments that try to intervene through policies, that's when it can disturb the supply and demand, as what we saw during COVID. Now we have a huge supply of money chasing less goods and services, and therefore inflation starts. What reserve banks did all around the world once they saw inflation starting to get higher and higher is they started to restrict the flow of money. They started to pull the money out of the economy by buying back their bonds that they've given out to the banks. They not only started to do that, but also started to increase the interest rates imposed by them to the banks and therefore to the consumers. And what that did was it took a lot of money out of circulation, again being filtered from interest rates that us as the consumer pay to the banks, ultimately from the banks, then back to the Reserve Bank. And from the Reserve Bank, ultimately to the bondholders that took them out. So it's a very important process. It's a dance that goes across many sectors of the world and many sectors of the money markets. If you want to be able to spot when interest rates rise or fall, these are the three things that you need to keep an eye out for. Number one, the unemployment rate. If we have a higher than normal unemployment rate, circa 6% or above, one would say that's almost at market equilibrium. Although when that unemployment rate starts to creep up to 7, 8, 9, or even 10%, that starts to show that we have a very shaky economy. Jobs are not being created. We have a substantial amount of people in the workforce that are not working, and therefore we're looking at some nasty things to happen in the economy and business alike. The second one is called CPI. This is an index, the Consumer Price Index, that the RBA look for. And essentially, it's the price of goods and services and how they have moved over the last, say, 1 to 2 years. And that's a measurement to determine essentially what your basket of goods is costing you in relation to, say, a year ago from today. And that's a great way to measure the increase. And is it in line with the Australian Reserve Bank's target, which is 2 to 3%. And the third one, which is not commonly talked about, although it is always at the back of the RBA's mind, it's the value of the Australian dollar. The value of the Australian dollar is so important in a globally linked market. And I'll explain why. Now, our dollar going down, unfortunately, yes, it does stop you away from going on your European holiday because your euro now costs more, or your American getaway because the American dollar costs more, but it has more consequences than just holidays. In Australia, we import quite a bit. Now, we do export. Contrary to what people might think, Australia has a very healthy export market. And primarily, we export a large portion of our agriculture and a large portion of our mining and minerals. But from an import perspective, we do import a hell of a lot of products and goods. And that ranges from seafood to other foods, from clothes, even to your common forks and knives that you find in your pantry or drawers. So every time that our dollar becomes weaker against normally the US dollar, and the US dollar is the denominated currency that really the world uses, our costs of import increases. And every time our costs of importation increases, that also increases inflation, which then increases the CPI, increases costs, and puts upward pressure on interest rates to continue to rise. So if you're monitoring those three things and really looking at what the RBA are releasing on a monthly basis. Now, for those of you who don't know, the Reserve Bank of Australia has 9 board members, of which they meet 11 times per year, generally the first Tuesday of the month. Now, they release certain notes, and those notes actually go through those 3 key indicators. And they're there as a guidance to let you know of what the Reserve Bank is thinking, what the Reserve Bank has discussed, and ultimately it allows you to make your own decision of where you think rates will go. Now, once you've considered all those 3 factors and you've researched and you've obtained all the information to understand where things are, now we need to interpret that data and understand what it means. Now, it's not as simple as saying, if we're here and that's there, this is where it will be, but it's a combination of movement and how all those 3 factors dance with each other. So let's go through an example. If we've got a high unemployment rate, which means we've got a lot of people not working and significantly low job vacancies, then that says to us things aren't looking really good. On the other side, we've got higher than normal interest rates, which means that we've got significantly falling job numbers, we've got higher interest rates, and our currency at the moment is quite low. I just wanted to make you aware of a short illustration that I've done at 2 ends of the spectrum, so to really give you a good understanding of whether interest rates will go up or interest rates will go down. Now, there are many factors. We've got 9 board members there that make a decision collectively for the interest of Australia, but wanted to give you 2 ends of the spectrum of what it would look like. So if we just have a look at our board, we've got high unemployment rate, we've got very low CPI numbers and a very high dollar. Now, in normal circumstances, that would give you downward pressure on interest rates. So to confirm again, we've got high unemployment, lots of people out of work. We've got very low CPI numbers, so the cost of goods is falling, and we've got a very high dollar. That's a very clear indication for the Reserve Bank of Australia that interest rates need to come down. So very much similar to the COVID pandemic. We're worried about jobs, dollar was relatively strong, and the cost of goods was not really increasing, if anything, quite stagnant or coming down. Therefore, interest rates went down quite sharply. Now the reverse occurs. We've got unemployment extremely low, so we've got substantially more jobs than what we have people to fill them. We've got a very high CPI, so we've got much more money still chasing a substantial amount of goods that really isn't in the market. And then we've got a dollar at the moment, which is, say, high to moderate. Now, a high to moderate dollar means we've still got some currency power. That would indicate that interest rates would go up. So I just wanted to share with you where we are right now from my personal opinion. And there's a lot of things that aren't aligning, making the Reserve Bank of Australia's job very hard. because there could be two swings or one swing in either direction. All of a sudden, they get the answers wrong. All reserve banks love a soft landing. They never want to see an economy broken. They want to make sure that it still falls inside their bandwidth of 2 to 3% inflation, obviously year on year. So I just wanted to share with you what I've put on the board and give you a little bit of context of where I think we are and the dilemma that the Reserve Bank of Australia have at the moment. And for anyone listening on iTunes or Spotify, head over to our YouTube channel, What School Should Have Taught You, and you'll be able to see this illustration. So right now what we've got is unemployment still at all-time lows. We've got CPI above target. Now again, the target range and the target band of the Reserve Bank of Australia is between 2 to 3%. At the time of this recording, we're still in the 5% band. And our Australian dollar at the moment is low and falling, around about the 63 cents. So where we are at the moment is unemployment is relatively still low. We've got CPI above target. Now keep in mind the Reserve Bank of Australia's target range is between 2 to 3%. We're still currently sitting at the time of this recording at 5% and above. And we've got our Australian dollar at the moment relatively low and falling, 63-ish cents. The dilemma that the Reserve Bank of Australia have at the moment is that they still want to continue a wait and see method. They still want to look at where is the landing going to be. We don't want to damage the Australian economy. We don't want to break the Australian economy. So with unemployment being very low, we've got inflation CPI above target and our dollar very low. That's all signs for an increased interest rate. And hence the reason why a lot of people are saying that yes, the RBA are aiming for a soft landing. The Reserve Bank of Australia at present have a much lower Reserve Bank rate compared to their counterparts around the world, such as the UK, such as the US, and such as Canada and New Zealand. We are a country which has been built on lots of debt and we are property mad. So these are things that you really need to have a think about, because at present, all indicators show that we should be looking at an interest rate rise. Very clearly, they've kept things on pause. However, notes that have been released do suggest that they are looking very closely at our Australian dollar, because as we mentioned prior, that if our Australian dollar decreases too much, then we do pay more for our imports. And by paying more for our imports, it increases our CPI. Therefore, costs of goods increase and we start the cycle again of high inflation. And therefore, rates really need to have to go above and beyond where they are currently now or forecasted to be to really control that inflation. Because as many Reserve Bank governors around the world have said in times of crisis, inflation is a cancer. And if you don't get it under control, it can really hurt an economy more so than high interest rates, as it's the invisible hand, or otherwise known as the invisible tax, that takes a large portion of your wealth away if you're not invested potentially in hard assets or investments alike. So a lot of people then ask, well, what are the opportunities that we might have from rising or falling interest rates? Now, as we know, as interest rates rise, money in the bank, it really starts to compound a lot quicker because the interest rate attached to the savings increases. Although on the other side, anyone with debt, we do have a much higher interest now that we need to repay back to the banks. So there is two sides of the equation. And you really need to make sure that you understand which side of the equation you fall on. And you need to make sure, well, how can I mitigate and protect what I currently have? So if you've got lots of debt and you start to see that interest rates may start to increase, you've got the opportunity to fix rates, which means you can lock in your interest rate for an extended period of time. And that gives you the opportunity to really solidify the amount of repayments you're making on a more known basis so you can plan accordingly. On the other option, if you are saving, you've got the ability to chase now some high interest rate accounts and start getting a better bang for your buck. Again, if you've got a loan, you want to make sure that you've created all your buffers. Those buffers are there to see you through the harder times. And you can almost look at the illustration that we have on the board to make a decision of where you think and create your own opinion of where interest rates may potentially be on or slightly after the Reserve Bank meeting, after you've read and reviewed all the facts and the notes. Also, a couple other things. During high inflationary periods, some people may argue that they move back to cash to take advantage of higher interest rates, and therefore it has the pressure to squeeze assets down. Although many economists may argue the differ, that during high inflationary periods, you want to run to hard assets. Those assets generally move with inflation, say such as property, even potentially precious metals. But wherever possible, you want to make sure that your assets are moving in line with inflation. And typically speaking, money in the bank may not move with inflation all the time. Hence the reason why they say sometimes money in the bank is not great. However, I believe in a very balanced approach. I believe in having some very strong buffers during high interest rate environments. And I further believe also having some really good money invested in some quality assets that move in line or above and have history of moving in line or above with inflation. And this means that you're always generating some level of growth, always generating some level of return. Because what they do say, if you haven't got assets moving in line with inflation, you are losing money. And your purchasing power diminishes by the difference, which means if you've got interest rates of say 2 or 3% that you're earning in the bank and inflation is moving at 5%, effectively you're making more than a net 2% loss because you've got to factor in sometimes some tax that we need to pay on the interest income that you're earning. So inflation is that invisible hand. It can create wealth and can take wealth away. And you really need to make sure that you're paying close attention to what the Reserve Bank of Australia are doing so you're not left out of pocket, number one, and you're not left blindsided, number two. The notes are readily available. And as I said, the Reserve Bank meets 11 times per year. So this is a constant evolvement of the Australian economy. It's a constant evolvement of the thoughts of the Reserve Bank Board. And these are things that have complete transparency out in the open market, which allows you as the individual to make your decision and to plan your investments around those specific decisions that potentially the RBA can make. So we've discussed why interest rates rise and fall, and on the basis of that, we know that it's there to control inflation, it's there to assist with employment, and it's also there to assist with our currency. Again, how to spot those little key moments is you really need to make sure that you're following what the Reserve Bank of Australia is doing, you're understanding the movements of the money markets, you're really looking at the notes that they're releasing, so it gives you a guidance of what to do next, and then you plan your investment around it. Again, in times of higher interest rates, we want to make sure we've got some really good buffers and diversified to potentially in investments that move in line or above inflation. And in low interest rate environments, we want to make sure that we're looking at solid investment returns from generally what they like to call hard investments such as properties, because they will provide, in most cases, sometimes a better yield. In saying that, very important to make this last comment about today. When interest rates go down, it means that we might have some hard times ahead, such as a recession or some form of economic impact. When interest rates are very high, we've got a very overstimulated market, a market that's growing way too fast, and therefore policy and restrictions required. So not necessarily when interest rates are coming down to all-time lows is it necessarily a good thing, as we've been led to believe in most cases. That balance of 2 to 3% is what the Reserve Bank of Australia has identified as the right target to meet for a very smooth and equal amount of growth and also cost in the money markets. My name's Jeremy Iannuzzelli, and I'll see you next week.